Hi, this is Bob Jenkins from Lipper. Welcome to another installment of the Meet the Manager video series. Today I'm joined by Franco Castelliolo and Bill Irving of the Fidelity Intermediate Government Income Fund. Gentlemen, thank you for joining us today. If you would, please tell us what your investment strategy is and why investors should want to invest in your fund.
Sure. I think this fund is a very good option for clients that are looking for pure government bond play in the fixed income space. Our process primarily is based upon defining a benchmark comprised strictly of U.S. government bonds in the 1 to 10 year part of the curve, and trying to outperform that benchmark by a reasonable amount of alpha in a risk control fashion. So the reason why we think this is important is because we feel like clients are looking to this type of product as a tool to be a ballast in their portfolio in the environment where maybe other risk assets are underperforming.
So for instance, in 2008, when the S&P 500 was down around 37%, this fund performed that diversify and roll. It returned a little over 10%. So it's useful as part of an overall, as a high quality fixed income component of an overall diversified portfolio.
So therefore it balances out other risky assets they may be holding.
That's right, that's the idea. And the way we, one of the key principles in trying to create that effect is we avoid investing in other areas of the fixed income market outside of U.S. government risk, things like taking credit risk. We avoid that. There aren't any corporate bonds in this type of portfolio. It's primarily U.S. Treasuries, other government-related sectors, things like Fannie Mae, Freddie Mac, Ginnie Mae, MBS, these types of sectors that we think we could still add alpha above and beyond the benchmark, but we could do it without necessarily taking credit risk, which we think our clients appreciate, and that's the kind of exposure they want.
Good.
And the purity, I think, also helps if you're trying to do asset allocation as part of an overall portfolio. And if you want exposure to credit risk, you don't have to be concerned that maybe you're going to get some of that exposure here. You can properly size the position and get that other exposure you want elsewhere in the portfolio.
Terrific. That actually leads to the next question. If you would, tell me a little bit about your investment process and what's made you so successful over the years.
Sure. What's I think unique about Fidelity's approach is we really sort of employ a team approach to our investment process. It's not just Bill and I managing the portfolios on our own. We have a very large support staff. That starts with our trading desk. So we have a dedicated trading desk of folks who focus, certain traders focus on rates, others focus on mortgage-backed securities, but they really act as our eyes and ears of the market. And their job is to surface good investment ideas, analyze the supply-demand dynamics in the market, and really keep their finger on the pulse of what's going on in the fixed income markets.
We also have a terrific team of research analysts, both fundamental analysts and quantitative analysts. So for instance, our fundamental analysts help us follow what's going on with government policy, for instance, housing policy, fiscal policy, monetary policy, all which have been important determinants of the direction of markets. At the same time, we employ a team of quantitative analysts who help us understand the value and the riskiness of the securities we're investing in, particularly in the mortgage-backed security market, which has a more quantitative focus to it.
Terrific. Now, if you would also, and given the securities you're invested in, tell us a little bit about your outlook for rates in general and the mortgage-backed market in particular.
Sure. The rates market, our approach has been, as I alluded to earlier, is to not get significantly different exposure, duration exposure, than the broader market. So we're not looking to get wildly short or long rates at any one point in time for a couple of reasons. One is we want to make sure that the portfolio performs as advertised, that you get 1 to 10 year exposure to the Treasury curve. But second, we really haven't felt like it's been necessary to get short duration risk all through this recovery process. Coming out of the fiscal crisis, we had the feeling that it was going to take a long time to recover. It takes a long time to recover from crises like the one we experienced. And with the Fed being as active as they have in the fixed income market, that was likely to keep rates low and range bound for a considerable period of time.
And I would add that discipline, I think, has served us very well over the past few years. For instance, in the springs of 2010, 11, and 12, There was optimism that the recovery was taking hold and that we were in a rising rate environment. And lo and behold, in each of those years, the 10-year Treasury yield ended the year lower than it had started the year. And so staying closer to neutral duration as opposed to, for instance, running short in anticipation of rising rates was good discipline that led to superior returns.
Yeah, as Bill mentioned, it's been a real tailwind to the performance of this fund. However, from here, we're constantly making this assessment about the situation for the rates market. And what we would say at this point is that, whether rates have to move higher from here really depends more on the evolution of the economy. We still expect, for a number of reasons, growth to be moderate this year, probably somewhere in line of what it's been like the last few years, say in the mid 2% range. And that's because yes, we're getting some positive signs from the economy. Housing's doing much better. It's adding to household net worth. Residential construction is picking up. So that's a tailwind to the economy. However, we're going through a period of fiscal consolidation right now from the federal government. So we've had the payroll tax increase at the end of the year, the increase in the marginal tax bracket, plus the sequester, which was not avoided. So we think the combination of all of those effects is somewhere around a 1.5 to 1.75% drag on GDP this year. So those tailwinds that we've talked about are being met with some headwinds, and that leaves us more sanguine on the outlook for growth this year, which means rates are, we don't expect them to move sharply higher, like, for instance, what some people are worried about, what we saw back in 1994. For that to happen, we need to see growth significantly higher than what we're currently experiencing, which is going to need a very, very fast recovery in things like the labor market.
Another consideration is the monetary policy. You have the headwind of the fiscal drag that Franco just discussed. And one of the tailwinds is the very accommodative monetary policy that the Fed is pursuing. And our outlook is that roughly those two forces are in balance. And that's why we think the growth outlook this year is likely to be on the order of 2% real GDP growth. And so rates should stay relatively low. We don't expect a sharp backup.
Terrific. So your feeling on the unwinding of the quantitative easing program is one that is going to be relatively muted over the near term.
Yeah, we think the Fed's going to continue to be involved in the fixed income markets through the course of the year. The debate that's going on right now is whether they start to taper off their involvement in the latter half of the year. And that's really going to depend primarily on how much the fiscal drag is going to lean against the economy. And we think it's going to be meaningful, and we think that the Fed is therefore likely to stay heavily involved in fixed income through the course of the year.
Okay, terrific. Gentlemen, I thank you for coming today and talking about your fund. It's been a pleasure.
Thank you.
Thank you.
Before investing, consider the fund's investment objectives, risks, charges, and expenses. Contact Fidelity for a prospectus or, if available, a summary prospectus containing this information. Read it carefully.